great opportunity to speak to our audience here today and talk about private equity and mergers and acquisitions and what's going on in 2024. We've had a very positive morning here with a lot of, Gene was very positive, and then we had a lot of discussion on the most optimistic group ever, the venture capitalist group. But they're always looking at the big picture years down the line. They are investing 10 years from now, not right now, right? He's looking a little closer to that time frame. What's working now, or what are we going to be able to do? Marty has made a good point that there's a lot of corporates right now restructuring what they're doing. PIETRO is going to speak a little bit about the industrial side and what that's bringing. Marco's going to go to the technology side. We've heard about that. It's a shame we didn't have any discussion on AI on our agenda here, Marty. No. We have Ben. Ben, who's going to be speaking about the healthcare space, and particularly healthcare is probably too general. He'll give you more detail on that in a minute. And then we have Mark Jennings here, who's going to speak to the new people coming into this, particularly from the wealth management side, investing into private equity and what they're looking for, how they're gaining access to this whole thing. So that gives you a quick overview about just a few things from Bain. Bain had put out their report. They put out a quarterly report recently. They're not as optimistic. So I'm sorry to do that for this group this morning after we had all that positive talk about Europe and venture capital market. They're looking at 10-year lows right now in private equity funds with 3.2 trillion in unexited assets. And there's a lot of pressure for liquidity coming from these, how are they going to get out of these deals? How are they going to get money back to their investors so they can invest in the next funds, things like that. 46% of those assets have been held for 4 years or more. That is the biggest share since 2013. So in time frame, it's a little over 10 years since we've seen these levels. Secondaries are still a small part of the market, but growing rapidly. We heard a couple in the last space who were doing, on the venture side, doing some secondaries, which is pretty interesting, and I think offers a lot of opportunity. And it's something very necessary because that play is so long. If you're an early stage investor, you're seed stage investor, the company's grown 30 times. And maybe selling it at a discount at that point and getting some of your money off the table makes a lot of sense. And without the secondaries being around, that's just not possible. So that's been growing and happening a lot more. Add-on deals are certainly very hot in the market. They tend to be smaller in size. So they're up to around 50% of the global market right now in terms of the deals that are being done, add-ons as opposed to platforms. So those are some things that Bain has pointed out, and I think it sort of sets a backdrop for our group and what we're going to be speaking about. Now, Mark Jennings, was very insistent on my reading the disclaimer here. I do it anyway. So information presented is for educational purposes and is not intended as and may not be relied upon as tax, legal, investment, or other advice. To the extent myself or others offer opinions, there are our own personal opinions and not necessarily those of their company. So there we took care of the legal stuff. Let's meet these guys. So let's mix up. Mark, we're going to start with you. You're the family office here. Kick us off.
This is for educational purposes too. Entertainment purposes.
So now
Fourth
I can leave the
generation family
apartment
office,
anytime, as
legacy,
soon as I leave by June
succession
30.
planning from a wealth management
Of
point of
course,
view,
I
but
will
also
move as soon as I can,
invest
as
in
soon as
all
I find an
different
apartment.
technologies
And
to
but the
mitigate
good thing
the
is
risk
that,
that we
like
had
for instance, if I
exposed
need
to
to leave
equities,
earlier, I don't need to
and
pay
also
the whole
to
month. If I need to leave late, like in June, I just pay those
I'm also
days.
looking forward to talk about Web3.
So what I'm going
A couple
to
months
do,
ago, you gave a very
my
interesting
secure deposit
presentation on that. So
was
we'll certainly
3,300, so probably with the interest is a little
PIETRO, you're
more.
sort of
So
a
I'm
different
going
breed
to ask them
altogether
to send a check to
to
you.
what you do. Why
Because
don't
I
you talk
owe
a
you
little bit about what you do and
$3,000.
introduce yourself to the group?
clear
I'm a
that,
practitioner.
that.
So I've been the private equity special
So
situation.
that's good,
my
and,
career.
I still have to
More
pay
than
the 50
steady,
today, but at least I pay you on
funds,
3.
bridge
And,
fund,
so you get the check
Richard's
right away
fund. I worked at Apollo,
from
worked
this
at
building.
People.
So everything is looking good,
There's a large
so it takes a
Vietnamese
little,
trader
takes
where
some
we
pressure.
get raised
off.
fund.
So if I don't find a
and
parking
we're seeing a
endorsement,
couple.
we can go back, you know,
Excuse
so,
me,
so all
Evelyn?
is looking good. I'm looking forward to seeing you.
You can mute
and I
yourself?
see you Monday morning.
Oh.
And
I think
and
Marty
happy
knows Marty.
Passover.
Yes.
I'll talk to you soon. Bye.
Evelyn, you're having a good conversation.
There you go.
All right.
There you are, excellent, thank you. All right,
So yes, I've been pretty much on the across the capital stack from kind of pure equity all the way to mezzanine. And I'm now senior advisor to a couple of groups. One where I worked previously, CIB Capital, one LuminArx, which is really a special situations.
so she's into special situations and, I'm sorry, what was the other one that you're doing right now? CGIC?
No, just private equity.
Oh, just private equity general, okay.
Fairly traditional private equity.
Yep.
Just special situations.
But you only like industrial opportunities?
No, not at all.
No?
Completely broadly speaking, from a sector perspective, there are certain sectors that I don't understand well. Biotech, technology, real technology, but done everything from industrials to media to services to
All right, very good.
asset heavy, asset light.
And you're looking at this from, why don't you state it, since healthcare is a little too broad for what you do, but it's really living your later years work better.
Yes. So Ben Brandis, a private equity investor throughout my career. I've been part of larger funds. I ran an SBIC investing in media communications for a number of years. And I formed NewOrigin Investments a year ago to invest in health and wellness geared towards the aging market. My thesis is everybody's aging. Which also includes impact investing.
Either aging or deteriorating, one or the other.
So that could include, many people are familiar possibly with home health care, nursing homes and facilities. Things that I invest in are products and services into those communities, such as mobility devices, communications between family members and doctors, residents. There's more people aging in this country than has ever been before. There's 10,000 people turning 65 every year. There's more people turning 65 this year. If I mentioned an aging stat, no one would be surprised. The demographics are phenomenal. But you know something? Go to any nursing home, go to any facility. They're not that great. The products and services that are geared towards people aging healthily, being happy, impact investing, can be better. So part of my thesis is I think this is a great area to invest. There's phenomenal companies out there, both pre-cash flow, revenue, post-cash flow, and there's not enough investors in the space, which is shocking.
So will you do venture? I know Pietro could test it. We got that off the prep call.
Yeah, all the VC people left here. What I was surprised about some of the stats on VC is they mentioned 10-year returns of like 25% or things like that. I was surprised that somebody didn't say the returns on some of these are 50%. If I look at most private equity offerings when they're raising a fund, you know, I barely see anything under 30%. Now, maybe they can't reach those criteria after a while, but I still think that private equity is probably on a risk-adjusted base, a better situation than VC. However, I am looking at some really cool companies, but I'm not expert at VC, so maybe I'll talk to some of these people about it afterwards.
No, I mean, there's just, when you hear a VC speak, you hear the things that they, you know, how much of it is going to be realized, how soon is the real question, you know? How quickly can these things be achieved? It's phenomenal what's coming. So Mark, you're up now. You're sort of talking about, you know, investors that are getting into the space. You're a capital raiser. Tell us a little bit about your company and what you're doing.
Yeah, Mark Jennings, Managing Director, Head of Capital Introductions, Byte Investments. So you know, those VC guys just get out too early, that's why they only get under 25%. You guys get the
Yeah, that's
30,
right.
50%. But, you know, our firm traditionally, was spun out of a placement agent that raised about $20 billion for VC, private equity, real estate, hedge funds, infrastructure funds. It was actually founded to start raising money for individual companies. After Lehman Brothers, there's good companies that need help raising money, and their investment bank only wanted to raise for X, Y, and Z. But going out there and raising this $20 billion, they realized that, you know, the majority of investors were the endowments, the pensions, the large family offices that were writing the $5, $10, $20, $50 million checks. You know, these are all, you know, $100 million raises for $300, $400 million funds. But what we noticed was there's a lot of high net worth credit investors, smaller family offices looking to access these deals that were too small. And we didn't really believe in that model. So instead of dumping, you know, $7 million trying to do next Park Hill, we incubated Bite. And we helped aggregate all those smaller family offices together to write one check as one LP. Now we've licensed the tech out to about 100 GPs, about 500 funds. So to your point, you know, you think there should be a bigger market share of investors. You know, right now that retail market, only 0.05% high net worth, you know, small accounts are invested in alternatives, right? 70% advisors don't understand alternatives. So there's an educational component to it. We just helped raise the largest European medtech fund in Switzerland, but we also, you know, that was 175 million that we came to 375 million fund, but 7 million of that was from smaller family offices and high net worth that wouldn't have had access to that if it wasn't for us. So, and I think that goes across whether it's PE, VC, whatever strategy it is, you know, it's kind of the wild, wild west. This is an area that they normally didn't have access to back in the day, but using technology and helping aggregate together. There's a lot more retail investors out there than there are institutional investors. The institutional guys are already 30% into alternatives already as it is.
Yeah, it's very interesting because you're reminding me, I worked with a venture fund back in the 90s, right? And this venture fund had a wealth manager raise all the capital for their fund. And after year 3, they started having real problems because everybody wanted their money out because they weren't really understanding the asset class. So that fund did not perform well. Just give you a bottom line, because there's so much pressure from their investors to get out of every deal they were in.
Well, that's why retail investors normally didn't invest, right?
Right.
Lockups too long, you know, 10, 15 years, the fees are too high, the minimums are too high, but if all.
And we had that discussion yesterday about fees.
Yeah.
You're not gonna put me through that
No,
again, are you?
I'm done on fees. So
You pay a
check
1 or
it out.
2% management fee, but you share profits.
To me, there's a real issue with alternatives in duration and in, you know, risk-adjusted return based on duration, right? So just because you have, you know, somebody's got a 20% return, somebody that's got a 21% return, but they lock up your money for 10 years longer, that's not a good deal because you lose all flexibility in how you can invest, right?
Well, yeah, you do lose there's some missed opportunities that, you know, that's all, if you read the legal part of your PPM, you'll see those risks in there, right?
I'm just saying that the duration-based premium should be higher.
Yeah.
Right? You know, so if they're doing 30% versus one, great, perfect. Then somebody should be looking at because duration matters.
You know, I think
Versus
you not
liquidity.
only look at the IRRs. The IRRs are one number, they're one statistic,
you.
right? You gotta look at the return on capital, so MOIC is much more important. You're shaking your head, but I think that's a more
You know,
important. But it all gives you real indication of, is this a good asset class, right? Is this something I should be putting my money into?
But to your point, that's why secondary's been so high, that's why carve-outs have been so high, you know, bolt-on. So,
Should have
you
got
know,
this
people
email.
don't, you know, they might want to settle for the 3 to 5x in 3 to 5 years versus waiting for the, you know, the 10, 15 years to get the 30% set. But, you know, by aggregating this money together, you can actually sell at the feeder fund level without having to sell at the top account. So people are willing to, you know, invest because they know they can get liquidity where before they couldn't and they were too afraid to do so.
Absolutely.
I would say
Yeah.
the lockup may be 10 years, I'm not sure the duration is 10 years, because if the holding period of your average investment is more than 5 years, you don't have fund 2. You know, so, and there's a lot of other avenues within PE to recapitalize and obtain liquidity in addition to sales. Now, maybe that was a lot easier when banks were doing better and interest rates were lower a few years ago. Hopefully that comes out again. But, you know, the PE has survived because they figured out how to be flexible in a number of environments, including this environment.
And I think the other thing we have here is we have three different people, right? Taking looking at the market three different ways. So we have PIETRO, who's primarily a private equity investor. We have a family office investor, and we have an independent sponsor here. So we have different ways of looking, different models. And I think that's part of what Ben's saying is there's, you know, PE's gotten very flexible and very ingenious in how we get the exits and how things happen. But why don't we just have, you know, why don't we start with you, Marco? If you would just talk about how you look at the market, how you like to invest, what sort of duration you like to be in for.
Mark, one second, I think, yeah.
Oh, did I miss a question? I'm sorry.
It was, has to do your duration piece, because a lot of people wanted some form of liquidity besides the secondary market. It started with BREIT and its interval fund, and it's now permeating a lot of different products, not just real estate, fixed income, illiquid fixed income, VC secondaries, add-ons and all that.
I'm sorry, what's the name of the?
Interval funds. It's a fund
Oh,
structure, gives you 20% liquidity usually per year, 5% a quarter. And it's usually, sometimes it's created as a 1099 for, as you said, especially the individual retail investor. But it's useful for some very large investors too, because if you want liquidity, they have to give you at least, 20% a year.
And you
So it's
mentioned
kind of
BREIT.
hybrid.
BREIT can only sell 2% a month, 5% a quarter. You know, that's part of the problem. You have so many retail investors that, you know, I was at GSO or 10 billion merger with Blackstone, 20 on 140, 70 billion of their 140 is off of 5,000, 25,000 checks to the BDC through FS investments. So, you know, you do have to be careful when you are taking this retail money, when you want to get out, there's only so much they can get out at one given time. But at the same time, if you create secondary vehicles or options for them to sell, without having to sell on the capital level, I think it does give an opportunity for retail investors to invest.
I don't want to dive into it now, but I think it also creates an administrative headache, and I know you addressed some of that, so.
Why you need my
Marco,
technology?
bring it back to you.
The way we're looking at this, and that's great comments by everyone. Anyway, for a family office, we don't want to be locked up anyway. So if anybody's gonna try and lock my money up for more than 3 years, I'm out. It's simple as that. But that's my criteria. The way we're looking at the market is technologies, going directly into technologies that are supporting synergistically everything that we own. So changing, for example, in the telecom deal that we made last year that we're 100% owners in Italy, I own all the technology. And I make sure that I did an asset stripping strategy on that, left them with all the debt because that wasn't my problem. It was the management before that incurred that and took it over. So now we have top technology plugged into Win 3, which is just like AT&T in the US. And with the hope that we'll become a full operator, allowing Italians with Italian numbers or any European with Italian numbers to travel globally and not have to incur roaming services. So then we added another layer by offering network content systems such as Netflix, for example. So we have our own version of Netflix where we take the film industry, documentaries from all over the world and just plug in and play. And you give that to the client, to that user base that you have for free. Today, you pay for Netflix on your phone and whatever devices you're connected, and you're probably connected to all of them because that's the business now. There's no TV cable anymore. It's all on your mobile, your devices, and so on. So we're looking for technologies always to connect, cross-pollination, and be able to offer that to our clients.
Do you plan to hold that company for indefinitely, or since you own 100%, it's different than what it's,
Funny enough, in this, it's called an MVNO. So that's a mobile virtual network operator, and that typically plugs into larger telecom companies in the world. So the likes of AT&T, T-Mobile that just bought Sprint, and so on, will have these smaller MVNOs that plug into a smaller geography or demographic area in a given sector. And those cents on the dollar become billions eventually. So yeah, I'm getting offers already in less than a year that they want to buy me out. But as long, when they put the right number on the table, I'm okay with that.
nobody's put the right one on the table yet.
I'll syndicate.
Pietro, why don't you jump in
Sounds
here?
good.
In terms of
Well, we're talking about how you look at the market, how you like to invest,
Sure.
giving your PE style, or even your special situations, maybe you want to contrast them a little bit.
Yeah, so it's gonna sound very much like basic, but what I like to see is value, where there has to be value. So that oftentimes means either buying at deep discounts or buying in very unique situations. So at the moment, the more attractive risk-adjusted returns are in the structured equity and structured debt area, where you can get more equity-like-ish returns or with some structure. So you have a little bit of protection. That's not always the case. During cycles, you can buy asset-heavy businesses at a discount because they have been burdened by the debt. And in growth type of environment, then you obviously have to change your approach. But fundamentally, it is companies with cash flow. Yeah. That's not the only way to do it. Then, for example, buys companies that have no cash flow at times, right? And it does very well. But primarily a very cash flow based approach, very value oriented, very deep kind of value orientation. And that's why you want to leave the flexibility from an industrial sector perspective, and also from capital stack perspective, from pure equity up to.
Could you help crystallize this with an example? You can do it on no names basis. I'm not, if you don't want to get into maybe a deal that you've done recently or a deal that you just, think really makes these points.
Yes, I was part of a fund that bought into oil and gas businesses or commodity-based businesses. We bought a very large business in Australia, and we bought it very well because the seller was one of the larger multinationals, and so carving out, they had their own reasons for selling. And so 2 or 3 things went well. One is we bought it at reasonably attractive valuation. Second, there was a refinery to which we attributed no value, and when refineries go well, they go very well. They generate a lot of cash, but owning a refinery could cost as much as $200 million just for the sake of owning a refinery. And 3, we did a couple of things to the business, such as a sale leaseback of a lot of the retail stations. So that's an example of a deal that IPO'd from 3 years into the investment, and we got 3.5 times our money, and so 50% of the, or is the fund.
3 years.
Yeah, it's just in time for market. But that's just one example of something that was more of an institutional investment. That's not something that a family would be able to do.
And what would you recommend for families to be looking at?
This is going to be a very controversial answer, based particularly on what my friend here says. I think families have a unique opportunity in this environment to do things that others cannot or will not. And that means 2 things, primarily. One is to buy into companies that are not well suited to traditional private equity. So that kind of have cycles that where you need to have a long-term approach. For example, I just helped a family buy a business whose EBITDA went from 3 to 10, back to 5, back to 8, because their customers are capital-intensive businesses, and so they buy these products, which are machines, only when they build plants. So that's one unique opportunity for.
That was a direct deal?
That was direct, yeah. That opportunity has always existed, by the way, not just now. In terms of.
I've been trying to make a point there. There's a difference between investing in a fund and investing in direct deals.
Yeah,
I think what families want to do is actually control that process of making the decision of whether to stay in longer or not.
Oh, then I got something for you.
Comment on Marco's.
No, but control is important if you know what you're doing.
You don't want to be in a
Exactly.
fund.
If you know.
You don't
what
want to
you're
be in a fund where the fund manager makes a decision and you're not able.
Because management can make bad decisions, and if you know what you're doing and you take over and control is given to you, and even the management is under your control, by all means, that's a hell of a deal.
there's a correlation, right? A lot of people are investing in funds to get access to those co-investments, even institutional investors that are writing 25, $50 checks. The whole purpose of them doing that is to get access to those co-investments.
I am not saying that family offices investing directly in private equity is not fraught with peril, right? It's terrifying. There's so many things that you can make mistakes on, and most family offices do.
Sorry, my second point for family offices specifically is that there are a lot of industries that are out of fashion at the moment. And there's a tremendous opportunity for family offices to buy into these businesses that BlackRock doesn't want to touch, or a lot of the other funds, the big funds, or even the lower middle market funds cannot touch for ESG reasons or whatever. And who is going to own the coal mines? Who is going to own the coal plants? Who is going to own these oil and gas pipelines, et cetera, et cetera? Somebody has to own them, and you can buy them for cash flow, just on a cash yield, and then there's some residual value. But the only people who can do this are family offices. To your point of family office wanting control, it's all well and good, except that most family offices are not well equipped to buy businesses. They don't have the people, or sometimes they refuse to hire people with the type of experience that's required. Only when you've built a holding company, you are essentially a private equity fund for all intents and purposes. And
Behave like so.
they've diversified private equity funds. But most of them have no idea how to do it. And they all want to go direct.
It starts from the beginning of the family office. Most family office CIOs are public equities guys. They don't really know how to do private deals. So if you're Marco, who's been in this space doing venture and private equity for 20 years,
25.
Yeah.
right? Sorry,
Come on, don't take it.
you look so young, it's hard to,
I
it's a different thing.
He looks good on this motorcycle.
Rolled out of bed.
Ben, we've been talking about a lot of different spaces, but let's get your view on this.
Well, I love working with family offices because the first word is family. And if I'm talking to various companies, I'm trying to convince them to take my dollars versus everybody else's talking to them. They may take my dollars if I'm working with a family office that has possibly a longer hold period, a different perspective than a middle market private equity firm, et cetera. Because there's rarely a situation that I've encountered, even if it's non-banked, there is some advisor that's letting them know you should talk to 100 of these potential investors and get the best deal possible. Okay, I may be able to offer an okay deal. There's no way I'm offering the best deal, but I may be able to offer the best partnership. And that is a huge benefit to working with them.
So talk about that. What goes into that partnership? What makes you able, what are you doing better than the fund can do or another company can do? Fill in the blank there.
Well, in most cases, I'm backing entrepreneurs and family-owned businesses that do not want to get out. Okay, so that's number one. So that may be different than a standard controlled buyout situation. But I'm looking for owners who want to grow their businesses. Maybe they want to take a little liquidity off the table day one, that's okay, but they want to grow their businesses. So they're looking for additional capital providers to be able to do so. In addition to debt, they don't want to leverage up all the time, et cetera. But more importantly, they're looking for guidance, okay? And I will provide that guidance. I will provide that network. I'm going to introduce them to Marty. I'm going to introduce them to these groups. They're using me for that particular network, for my expertise, and the fact that I'm going to be a true partner with them, along with possible other capital providers who have a longer-term partnership approach. If you talk to, many middle market companies that their limited partners are demanding them to get out within 3 to 5 years, there's no possible way that they can offer that.
So you're not doing control, you're doing growth.
I am doing growth. It could be options or different types of structures to maintain some level of control, but it's got to be, we're all aligned. There's no way that I'm going to make out or I'm going to take out control without hurting myself, and that partner knows it.
What I love about family offices, they can make decisions fairly quickly, right? You know, you go through these institutional investments in 6 month, investment can be
Yeah.
processed. So for family office, especially if it's a single family office. So when you get into the multifamily offices, they can syndicate it as well. But, also though, the funds sometimes don't like the family office because they're the smallest check, but sometimes the biggest pain in the rear end. So that's why they like us to syndicate it and create, 100 people, $100,000 and write one $10 million check because they're dealing with a fund and they don't have to deal with those 100 people with 100,000. And more of these funds are now coming to us saying, hey, we got 15 million in multifamily offices, sub-$1 million. We're turning away that business because we don't have the back office infrastructure to facilitate. If you can wrap it up right as one $15 million check, we have another 50, 100 behind it. Anyone below $1 million, we're going to send them to you and your technology and your platform to aggregate together because they want to get in with the retail, but they don't want to get into the trough or the trenches, and get their hands dirty. They want it wrapped up with a bow. $10 million from a family office or a retail is the same color as Harvard and Downing or anywhere else.
So quick question. You're bringing all those people into a fund. What structure are you using to put them into the fund?
Oh, it's the same structure as if they were going, it's a feeder fund, right? So you're wrapping it up, you could charge them a fee on top, but if they went direct, they'd be charged 10 times more, to go direct than going through the feeder fund. So it's actually more beneficial, lower fees, better liquidity, and they're getting better share class, right? If they were going in, they would have been going into a retail share class and paying 3.5, 2 and 20, whereas now they're coming in institutional share class, paying 1 and 17.5, and they could sell their feeder fund without having to sell at the top of the level. So that's very attractive for more retail or smaller family offices, and they can write smaller checks.
Yep. I want you to give here, same question I put out to Pietro. Give me an example of a company that you recently bought into or so people have a way to really crystallize what you're doing and how you work.
Well, I have one portfolio company under NewOrigin Investments that I invested in about a year ago. It's a manufacturer and franchisor of mobility devices. They manufacture their own wheelchair ramps.
We'll talk about this because when you said that to me, I thought, well, this residential little thing up in front of the house, it's not that at all.
Yeah, no,
this is a much bigger opportunity.
Well, if you run around New York City, and you go to these buildings, you'll find out that half of them are not ADA compliant. They don't even have ramps. And if they did, the reason why they don't is because actually to put them around the buildings would be like hundreds of thousands of dollars, and no landlords want to spend that. The company that I invested in produces those type of ramps. So if anybody were to crack down on the ADA compliance, I'd be a gold mine in a day. Okay? I don't foresee that happening. But just to give you an example, it's a really good, I know wheelchair ramps are not as exciting as AI technology.
Oh, they're electric vehicles.
Yeah, that's absolutely true.
And maybe.
So these are modular. Each piece is the size of the top of this chair, or a chair. And they manufacture all these little pieces. They ship them out to the distributors, and they put them together like Legos at the various facilities, and they can take them off and store them, et cetera, et cetera, et cetera. They're also used as anytime that a university has a graduation or has an event, you usually have a platform. That platform is required to have a ramp. So they produce, these ramps. They lease them out to the universities, MIT, Harvard, BU. I can name 100 in Boston alone. And they put them together for a day, take them apart, and then store them for a day. The price inelasticity of that is greater than any business that I've ever seen because everybody's desperate to do this, otherwise, and no one ever can get to the platform.
What's the price?
The price is
For a day?
The price for a day can run from anywhere between $75,000 and $250,000, depending on the event. If you go to a Billy Joel, concert, you're going to have all of this. Now, yeah, it's
Really good old days.
it's unbelievable. But without going to the story too long, I got to know it's a family-owned business for 20 years. Father built this from scratch and was looking away for generational transfer. So I backed the son to buy out part of the father's interest, some liquidity day one. I have an option to increase more, and I'm working with the son who's under 40 years old, okay, has some experience. Can he run, you know, a $25 million company? So it's not a huge company. Can he run that by himself? No way. Okay, needs help, needs guidance, et cetera, et cetera. I'm at the manufacturing plant. I'm working with them. I'm having a blast. It's a great company. It has impact, you know, so.
The trends are in your favor too, demographic trends.
No question about it. But I mean, they're looking into, again, they manufacture their own ramps, so that's their own, but they're also sell mobility devices through their distribution system in the franchise
And
level.
just license it to Marco and he'll distribute all of Europe free.
There you go.
No, it's brilliant because in Europe, I think it's probably demanded in Europe and also the population is aging.
That's right.
But at the same time, I doubt anybody's in compliance with it at all.
Surprisingly enough, the Rams is not really a big business
Yeah.
in Europe.
No.
Or nursing homes, I mean, we kind of take care of our own.
Or ADAs,
Yeah,
right,
you're
big
exactly.
laws.
We take our
I just
own
want to make a
buildings.
point about Ben's business, and I'm not sure, I think Pietro, I'm not sure if you're not, are you a part of a fund or an independent sponsor as well?
No, I'm not really an independent sponsor.
Okay, so, but Ben's business is very interesting because he is the relationship.
Right.
You're the guy who starts a relationship that all these larger private equity firms are looking, will never make.
Right.
Because they're just looking to do transactions, so.
Right. I mean, just one, it's a great point, is that, so if you looked at, like, I don't know what it is, it's gonna be like 95% of the deal flow that private equity firms, that funded private equity firms invest in their bank. They're coming from some level of investment bank. Okay, we talked about this the other day. The idea of proprietary deal flow is, you know, fake, fake news. You know, so what I do is I'm trying to meet, you know, as the independent sponsor model is, I get deals from banks too, and I know all these small banks that maybe other people wouldn't know these small banks, but I'm getting deal flow because I'm going out grassroots, meeting owners of companies directly. Hopefully they're families that really, really want to, you know, grow their businesses. So that's the part that is the most difficult because that's like, you know, a low probability of doing the deal, but then when you do the deal, it's great.
Now, a lot of independent sponsors work both ends, right? You funded this deal yourself. So
Yes.
this is what, so in the future, you're gonna bring family offices into your mix here, or?
Yeah, I act as my NewOrigin Investments acts as the GP. Family offices would, and other investors may act as the LP. Now, again, it's not necessarily two and I'm not charging two. You know what I mean?
Right.
Or whatever, you know, et cetera. No one's, you know, that's ridiculous. So, you know, there's other better economics. My cost of capital, my infrastructure is a lot less, so it doesn't take as much to make my economics. There's a little bit of a carry, but that's, yes, I get my LP money from other investors rather than a dedicated fund where, you know, I can't just like commit that capital for deal. I got to go deal by deal basis. But then I'm not cross-collateralized the deal. My mandate's a lot greater. I can do a whole bunch of things that I would not normally be able to do in a fund.
Now, Marco, I want to switch over to you because as you spoke before, you mentioned you bought this company, then you figured out you plug in this and plug in that. You seem to do that a lot.
Yeah.
Is that your model? Is that how you like to approach the market? Talk to me about when you start off with an idea. And where's your mind right now? What are you looking to? Are you looking to get into new areas?
Yeah, sure, always. I mean, what I've said in the most recent interview at a TV channel is that I like to disrupt what's status quo. Meaning, most of us get used to systems, technologies, the status quo, right? When I look at it, I'm not happy, and I like to disrupt. I like to make it better because things can always be better, just like we can better ourselves. So that's always been my philosophy towards investment. And when I find that one company, I try to see every possible way to connect it to the other. For example, in the electric vehicle sector, which you know we rebirthed our legacy that started in 1903, making motorcycles out of Italy, is right now the only OEM doing this. So the question is, how come nobody else is yet doing it? I mean, there is Tesla, there's motors in the automotive, but in the two-wheel sector, there isn't really anything but what you see around, which is poor quality material, poor quality vehicles. But we're the first company in Italy doing this. So how do we connect this to a telecom company? Well, I have a platform of 100,000 people that are making about, on average, 10 phone calls a day sending SMS, messages, probably about 30 on average per phone. So when you do these numbers, and you understand that you have now a distribution platform where your product, your brand can be somehow be mentioned, because they're advertising also behind this, it's free. It's advertising dollars that I'm not paying that could be very easily be worth 5 to 10 million that I'm saving, but at the same time, I'm promoting both companies to all my content, and that's cross-pollination.
You also did that on the Web 3.0, right?
Yes, sir. So in the most recent development, Web3, we took Web3 and married it with blockchain, creating what I call the gamification of your business. One of the things in the automotive sector or two-wheel sector that is really expensive and it takes a long time is prototyping, right? You can design whatever you want, but then create a prototype and get the feedback from a market to understand if you should go into production. That's a whole different story. With the Web3 gamification, you allow people to take a look at all your designs in 3D and give you that feedback for free. Again, I'm plugging into an existing distribution channel and they're playing with it and they're telling me, this is feasible, this is viable, you should do it. And that's how I go to market. And it saved me 3 years of time because I can do that within 6 months.
And it allows you to plug other brands in there too.
Essentially sponsorships.
Yep.
Sponsorships eventually could be beer companies, could be, wheel companies like Pirelli, tires right now is working with us, Brembo braking system is working with us, Ozeta is working with us, which is the wheels. So yeah, these larger multi-billion-dollar companies now want to be part of this, so they pay for it.
So I think it goes back to, ecosystem, family, families like families. Companies. I come from a 100-year-old family construction company. You see a lot of companies that, they want to have a liquidity event. They want to keep their name on the brand. They want their son or their grandson to be able to work, granddaughter, be able to come in and work in the family business, but they also want to take some money off the table. They look at private equity and venture capital and they see, oh, they're going to buy my company and chop it up and sell it in pieces. So that's why I think this ecosystem, this family, the relationship is so key for these businesses that, and that's why technology is so key. Having these people, looking at making 10 phone calls a day, having 100,000 people that he has in his network. That's why technology kind of connects the ecosystem together to be able to look at these opportunities and put families together for the right opportunity.
One more thing, the suppliers, tier 1, tier 2 suppliers, the people that nobody wants to talk to them, invite them. I create events specifically for them in settings like this, while they all get to see each other, and I put the final product on the table and said, this is because of you guys. Starting with my design, this is you guys. And you build that network. And that's extremely important when it comes to ordering. As opposed to BMW that orders 5 million parts, I can order 5. Because they're gonna look at you, why should I make you 5 when I have this big client? So it's relationships build it as well. This is all family related.
Are you concerned at all that when you build all these interconnectivities between your companies that you try to sell pieces of them, you want to sell this business at some point in the future, that they're being, when they're removed from that it's going to diminish the value or make it less attractive to a buyer?
If I'm not involved directly,
If you're not involved
as a
directly.
family member, yes, it does take away the value. Typically, if anybody buys me out, they want me to stay for 5, 10 years. But I'm also very expensive, so.
Now, one second question is, on your electric motorcycle, I always think of people riding motorcycles, half the thrill is the power and the sound of it, right?
Yes.
Do you generate the sound with your
Yeah.
bike?
It started from the design of the engine, and it has its own turbine sound like, and then we added AI technology to give extra amounts of sounds or variations of sounds. In the case that you're an old school person, you want to hear the drone of the motorcycle, but it's an electric motorcycle. So yeah.
Without that, the movies aren't as good.
Yeah.
So just quick question on that. So if I buy a motorcycle and Mark buys the same motorcycle, I could have a silent one and he can have a noisy one?
Yes.
And we can change it
Yes.
depending on who we're trying to impress?
Yes. Yeah.
You can have the noisy one.
Tell them your 0
What's
to
that?
60.
You can have the noisy one.
Well, our 0 to 60 was initially 2.3 seconds and now it's 3.2 because I had to adjust it to make sure nobody flies off of it.
Regulated, not regulated.
So Pietro, when you buy a business or you start investing in a business, you're looking potentially, to sell at some point in the future, right? So how much of your exit are you thinking about when you're buying?
A lot. So I do, obviously, we're talking about buyouts, not kind of the structured equity, structured debt or rescue capital, but a lot. And in fact, I didn't realize when Marty's not here that this will be kind of a beat up on private equity section. But there's a lot of actually relationship building in private equity as well, because you do have to manage businesses and you have to make sure they have the management has the right incentives. Leaving that aside, when at the entry, you do think a lot about the exit. And that doesn't mean that you need to think that the company should be saleable immediately, but you have to have a path, or at least a plan as to how it will be saleable at some point. Be it through acquisitions, and you all have mentioned that the add-ons has been in vogue for a long time, and in fact, recently it's, as you said, from the Bain Capital report, has been one of the big elements of private equity. That's because it's been difficult to buy other businesses, not because it's the only way to create value. So add-ons or transformation, starting new lines of business, closing new lines, geographic expansion, all of these can be value creating or with a view to an exit. Oftentimes you try to buy a business at relatively inexpensive valuation multiples with the hope that if you grow it, you'll get a valuation, a multiple expansion.
And that was one of the things I think Bain also was emphasizing was that, you got to dress up the investment if you want to sell it and get some excitement behind the company, right?
Dress
So-
up, that's something that
Put some
investment banker
lipstick
would be, they do.
Well,
Say,
That's
From a
my
private
opinion,
side,
you know,
you should always have a valuation report.
Oh, exactly. So how are you gonna build value in? So you can do an add-on, you can change management, you can do different things. So you're seeing a lot of that happening right now with portfolio companies. And this is something that's taking place. So I imagine those firms that are looking for placing CFOs and CEOs into portfolio companies of private equity firms are probably doing very well right now. This is the time for that.
But back to his point, a lot of these deals are coming from the investment banks and they're not, originated or everyone thinks, oh, it just magically happened. But, it's seed to sell, right? Believing that under $100 million investment in a company or even a fund, most people won't even look at that. But, if you believe in people early on and you give them their first $5, $10 million check, they tend not to forget you when you're a multi-billion-dollar company because you were there from the beginning.
Absolutely.
So
I actually have a broker dealer question. I think there's a broker
You
dealer
don't mess
issue.
with advice.
I think there's a broker dealer problem in the country, which is that, people are gonna raise money. I mean, they I guess they have binders now, but like, if you're not a broker dealer, broker dealers only really handle a certain finite amount of companies. So most broker dealers aren't gonna step into the venture world. They're not gonna step into lower middle market.
Well, that's the whole point, right? Is that the broker dealers won't step into, the wires won't step into it. So this is a void that you're filling in that, there are ways to invest into companies that, doesn't have to be approved on your Morgan Stanley, UBS, JP Morgan, or Schwab, Pershing. We have a company that we're partnered with, and it was actually a post-made-up world where all those banks, broker dealers wanted these alternatives off their platform, right? And this company has 60,000 alternatives. They have 46 billion, 700 RAs. Right now, they send an Excel spreadsheet to those RAs to show them the opportunity, but they can facilitate someone investing from their self-directed rate, their brokerage account, their onshore offshore account, and they aggregate that together and they write fairly large checks. And people are looking for something different. They don't want the same old thing that everyone else is offering. So that's where the opportunity is for retail, I think, in smaller family offices to participate in things that normally they couldn't get into unless they're a big, pension endowment.
But still, a lot of deals go to auction. I think we did a PE panel 10 years ago in San Francisco. We said, what deals don't go to auctions? Almost everything goes to auction or has an advisor. Because that world is,
I think it's less auction today than it was 10 years ago. It is definitely less auction.
everybody else, your thoughts? Is there less auction than?
Well, I mean, an auction, yeah, I mean, an auction is used for buyouts. You're usually selling like a majority interest in the company, not necessarily for growth capital.
Okay.
Okay, so I would put that, now, it doesn't mean that growth capital is not being represented by advisors. Some are broker dealers, some are, who the hell knows who they are, right? They could be lawyers or,
There's a lot of lawyers out there doing that,
There's
accountants.
nothing wrong with that, or somebody's got brothers, cousins, like nephew who works at like a bank or something like that, so. Usually there's somebody involved, but yes, the problem with the pure auction is that there's no level of inefficiency in participating in that. So then you need like to have these larger private equity firms that somehow have like unbelievably possibly made up value creation plans because they're paying top dollar through an auction. Okay, so lower middle market private equity, earlier stage independent sponsor equity is way below that radar. There's 2,000 independent sponsors out there. No one's participating in auctions.
And you're saying a lot more
With
of
a greater
strategic.
respect, I completely disagree,
Oh, good.
because almost all of the independent sponsors that I've come across have, for some way or another, had won an auction by paying the highest price. So
Really?
it's not true.
Interesting. Wow.
And frankly, the world is becoming more intermediated, not less intermediated. And growth may be a specific example, but if you think about private credit today, there are advisors who specialize in kind of funding private credit, right? There was an article on Bloomberg yesterday.
It's a big
Huge business. And
Yes.
so throughout the cap stack, be it minority growth, be it buyout, be it rescue capital, mezz, there are intermediaries.
Well, I'm gonna
But
switch
that
my
doesn't
hat
mean
here
it's
just a
not
little
fine.
bit, Marty.
And before we talk about getting back into private credit, is how much things have become syndicated. So in the old days, a private credit guy would do 90% of a deal. Today, you're lucky to find a private credit guy who's doing more than 25%. Everything gets syndicated. Everybody's, because there's so much online technology out there, helping people build these syndications.
I told you to get back to WOB.
Yeah, we're here,
Just
okay?
like
Well,
yesterday.
Pietro said when you're out of the room, we're smart, you're gonna beat up on them.
I said, this is a PE beat up question.
This is a PE beat up session here, so
There
he's
you go.
swinging
No,
back a
I
little bit.
get, I think venture is far more sensitive to interest rates. Like if I was in venture right now, I'd be doing venture debt, which seems to be great, right? But I think PE, as much as leverage is a part of it, there's still great opportunities. There's the retirement gold rush that people are trying to, boomers selling their businesses. You've got this great immigration of people from all around the world who are gonna start their own businesses and need help. That aren't gonna be, they're not venturable at all, right? It's somebody was talking about like bowling alleys. Things like that, right? So.
And look, this isn't a beat up PE panel, right? PE plays an integral part in the process, and the world wouldn't go around without PE these days. But at the same time, I do think that each sector, or at certain times they become hotter than not. And right now, I think it's more of the secondaries or the areas that people are looking for liquidity, and PE's been doing very well for a very long time. I think it will continue to do very well. It's just
I still think there are large companies out there looking to buy.
Yeah.
Even though they're selling off some divisions, they're looking, what's our core? What do we have to grow? How do we position ourselves for that? And that's where, you gotta know who to approach and how to approach them. And that's something most CEOs don't have.
We also haven't had any IPOs in the last 3-4 years. So, that's why there's companies sitting on their books for 4 years that they haven't been able to capitalize on because the public
right.
markets have been, go ahead.
I'm sorry.
No problem. Majority of investors don't like to deal with the broker. That you find that at least in the series that you see, you're hearing from venture guys that We have a broker dealer, so I'm not biased, I don't agree with that. But when you approach, venture funds and so on and so forth, or you're not going to specific family offices, people get turned off by having the commission.
Well, they don't want, yeah, exactly. They don't like paying out fees, but at the same time, a broker is an integral part of it because, if the client doesn't understand the investment, the broker has to explain it. They have to syndicate it together. So it's too bad they don't like brokers, but the broker's an integral part.
I'll be truthful with you. They all love you if you have the right deal.
I work with brokers, but it's a matter of show me what you can do.
Right, so do
Because
you,
if I have
do you
to
take
do it,
calls from them?
then
or do they-
if it's the purpose.
Right.
Depends on what kind of broker or where they're at.
No, the.
Guys, we got about 5 minutes, so why don't we get down to the last few questions?
All right.
Mark, may I ask a question?
Sure.
Ready? Ready?
We're all set.
Wait, it's teamwork here.
All right.
Is this Planet?
Would love to hear how you guys think through adding value to the investment companies. That's capital, content, customers, just any examples, would love to hear this.
Yeah, and I think there's, Marco, you can start, but I also think Pietro has a lot to contribute and
Cash
Ken
is
has a lot,
king.
so.
Cash is king. Distribution is King Kong.
I like that.
Distribution.
Well,
That's my new quote.
Nice.
And I like to talk.
I was gonna say strategics, but you're right.
Well, I'll say digitalization. I think the easier, faster, more efficient you can make it for people to weed out the ones that are not appropriate. 95% of the deals are not ones that you're gonna seriously take a look at. So if you can save time and be compliant and make it easy and faster, so it's swipe left, swipe right if you want to invest in a company or fund, I think you'll have a much bigger market to participate than, the paperwork way.
I think different stages of companies, you can add value different ways. Companies that Ben is looking at, there's a lot of very basic blocking and tackling that he can help them with. Larger companies that already have a sophisticated management systems, etc., they're gonna have to be more strategic or more kind of bigger surgery, frankly, big things. So either you divest a division, or you acquire something else, or you do a sale leaseback of a lot of assets. It has to be like something major. In general, in my humble experience, I found that there's a lot of money to be made by just keeping your eye on the ball and just doing a lot of little things better. A lot of money by just hanging around the hoop and then doing the little things right. Changing management when necessary, improving management, improving some processes, improving the distribution. There's a lot of things that companies don't think about a lot. Earlier stage companies have different problems or opportunities than larger companies. It's always been that way, and it will always be that way.
And making it international, the world's a much smaller place. In post-COVID world, people aren't flying around going to super return conferences every day. They're looking to access markets that they never knew existed. So,
right. I mean, we have a quote unquote playbook, and by the way, I hate that term. But we have a playbook, and if I have, it's simple, and if I have 10 points on this playbook, consolidate your accounting function. Let me see your tech stack of your software. How are you distributing your thing? I will tell you that it's 9 out of 10 usually. I don't know which 9 out of 10 are not being met. It's easy. Sorry, it's not easy to execute, but it's easy to identify what's not being met. I'm there to help execute. But I will say that the 11th thing, if I have 10 of them, the 11th thing that's not on my playbook is therapy.
That's
All right.
definitely a needed skill.
Yeah, no, not for me. I need one too, trust me. But
we all do.
yeah, the owners of businesses I've talked to, they have no one to talk to that they trust. There's no one there. So, I try to provide that element that call me anytime, 24/7, you can talk to it. I know I'm an investor, but we got a shared situation here. We're in this together. You can let me know. That communication is key. That's not in the playbook.
So I think we short answer to sort of sum up, we've heard 3 different versions of, or 3 different ways to approach this market from 3 different, private equity investors up here. Pietro certainly brings what I call the strategic side and how to improve the operations of a business, or by adding on or doing those strategic elements that he brings to the table. You have Marco, who looks to interconnect all his companies and build a,
All the viewers in the world.
There you go.
Marco.
Who looks to interconnect all the,
Interconnect.
all his businesses and create a premium on top of what he's built at the initial core of the platform. And then you have Ben, who's very hands-on, getting into the nuances of the business, from the accounting to the manufacturing floor, and really looking to where he can build and add value to the group. And then last but not least, we have Mark, who's consolidating this large group of investors who've never been in this, educating them, making it easy for the funds to operate or the business to operate with those investments. So thank you. I thought this was a great discussion. Appreciate it.
All right, great job, guys. Thanks so much. We're gonna be back in Los Angeles in Century City during the Milken Conference. Gonna be there on May 8th and 9th. We've got a fantastic group of speakers. John Molina is gonna be speaking there. He's probably the leading investor in Southern California in carbon transition, energy transition projects. And Jessie Draper is gonna be there. She's one of the leading investors in women-led companies. So it's gonna be fantastic. Art Gover will be speaking there as well. So looking forward to it. Thanks so much for making it, guys.
Thank you, Marty.
Are we taking a tour now?
You guys can send me a deal. That'd be great.